Good afternoon, good evening, good morning, wherever you're in the world. I'm Mark McAllister. For those of you who don't know me, I'm the senior partner for Holborn Assets down here in sunny Cape Town. And I've been helping returning South Africans and British expatriates alike around the African continent get themselves financially fit for the future, and in particular, focusing on an area of specialism around the use of UK pension structures. UK pensions have been very much in the news in the recent weeks, particularly after the recent budget, and I'll touch on that at the end. But this webinar is designed really to allow you to know how to navigate the use of a UK pension structure when you relocate offshore, you turn back predominantly to South Africa. For those that wish to contact me, feel free to use any of the contact details below to follow me on social media or drop me a WhatsApp. You can scan this QR code and it will allow you to send me and my team a message via WhatsApp immediately. If you've got any questions, don't hesitate to ask them via WhatsApp or using the Q&A button that should be at the bottom of the screen. So this is what we're going to cover today. I'm going to take you through the basics of a UK pension, what the various main different types are, how you take benefit from them at the point when you're able to access them, and then how the tax around UK pensions works, and what your options are if you are a returning South African from the UK. Lastly, a little bit on our free pension MOT service. As I said at the beginning, you're more than welcome to ask any questions as we go along, and you can do so either online via WhatsApp or using the Q&A button below. So let me start off a little bit about us. So who's Holborn? Well, we've been around since 25 years ago, started in 1998. And now we've got nearly $3 billion under management administration across the globe, spread over clients of 30 different countries, offices in 11 of those countries. And you can check us out on Trustpilot, where we've got over 2,000 happy client reviews with an average score of 4.8. So I like to think that we are doing something right. So let's get started. What is a UK pension? It's a tax-efficient vehicle to help you grow and protect your savings to provide for your retirement. Obviously, these are designed for people in the UK, working in the UK, and more often than not, retiring in the UK. So you're encouraged to do so, and you're given various different tax incentives to do so, so you aren't a burden on the state later on in life. So generally speaking, they're tax-free on the way in, and then they're taxed on the way out if you stay in the UK. Some of them provide a pot of cash that you can use at a certain age. Others provide a regular income stream through your retirement. And we'll talk about those different types in a minute. Whilst you're abroad, it's likely that you will have paid into some form of a UK pension scheme. So when you're in the UK working, particularly in recent years, you'll almost certainly been signed up to some kind of a workplace pension. After your property, statistically, this will be your second biggest asset. There are currently about £19 billion of unclaimed pension pots. So the question you need to ask yourself is, one of them potentially yours? And could we potentially reconnect you with something you didn't even know you had? And we've had that happen a few times before over the years, where we've put people in touch with pensions they didn't even know that they had. A few changes you need to be aware of. In March 2017, the law in the UK changed, and what that meant was that it was less attractive to transfer pensions out of the UK if you moved back to South Africa. Prior to that, there was a number of different options where transferring it could have made sense, but if you do it now, it results in a 25% exit tax. So these days, nearly every UK pension that we manage is done so in the UK, stays there, but we help administrate it remotely from South Africa. Why did they change that rule in 2017? Well, it was seen in the industry anyway as a way of reducing the large number of overseas transfers, which ultimately then resulted in less assets under management under the UK's government control. That was really brought into focus in the autumn budget. The new Labour government have, for the first time ever, brought UK pension pots into the inheritance tax net from April 2027. So not right now, and therefore it's something you need to think about. And I've covered that in a recent webinar in depth. on those changes. So you've got a couple of years to plan if you've got UK pensions that exceed the UK IHT threshold, or if it's combined with a bank account and cash account and properties, UK investment properties perhaps left in the UK, and you've got more than a few £100,000, it's probably worth a chat with somebody like myself just to see whether you've got an IHT bill that's starting to build in the background under those new rules. Okay, let's move on to the main types of pensions that you probably have or maybe have interacted with. So the first one is the UK state pension, so provided by HMRC. We can't do anything with that. It is provided by the government. What we can, however, do, and we'll cover it in a second, is explain how you might be able to add to that, even though you're back in South Africa after some years later. A defined contribution, often known as a money purchase scheme, is effectively a pot of cash that's used to buy investments, and those go up in value over a period of time. The third type of scheme, very different. I'll go into a bit more detail on both. A defined benefit scheme, so often referred to as a final salary scheme, but it's ultimately a ongoing known amount that's paid linked to how much you were earning when you stopped working for that employer. We'll come back to those in a minute. Let's start with the UK state pension. So here's the key facts that you need to be aware of. So there's various different types depending on your age. Most people will have the new state pension. And ultimately, if you get a full state pension, you'll be getting £221.20 a week from the UK government when you hit retirement age. A full new state pension requires 35 qualifying years. So if you've only worked in the UK for a period of time, you might not get a full UK state pension. But one of the things you might want to do is then buy back missing years, and you can do that from South Africa. You can usually pay voluntary contributions up to the last sort of 6 years or so, but there is a very important deadline that I'm going to talk about in a minute if you've got maybe a missing gap going back beyond that 6 years. How do you find out what you're entitled to? Well, let's start off very simply. Check your national insurance record online. So go to this website, which is www.gov.uk/check-state-pension. If you haven't already got one, you'll have to get a government gateway ID. And once you've got that, it will allow you to know what you have in your state pension entitlement. So this is what the website looks like when you arrive, and you need to sign in. So if you haven't got a government gateway ID, you'll need to register for one. I'm not going to cover that here, but it's fairly straightforward. And once you've done so and logged in, you'll get your state pension forecast as of today. So you can see there's my one at the moment. I am in the queue with everybody else waiting to get my last 8 years of missing contributions added in. So hopefully this will jump up in the not too distant future. So you can see here that there is a number of years that are left to get, and this is potentially what the maximum is for me if I get to that full level. If you click on View Your National Insurance Record, you'll see here that currently I've got 18 years of full contributions from my time in the UK, but 26 years that I haven't contributed, or sorry, that I can still contribute, and 8 years where I haven't contributed enough. So I need to potentially add some more funds to it. And you can see here it sort of highlights all of that. You can check your national insurance record manually as well. You can do so by downloading a BR19 form from the .gov.uk website. There's the full link if you want it. If you're not sure, then just email me or WhatsApp me and I can send this over to you after the call. Long story short, once you know if you've got a gap and you want to add back your national insurance contributions, you can do so. And here's a little guide. You can go to this web address and learn a bit more about it. But I'm going to just take you through how you can do it. You don't have to fund the Class 3 version. Okay, there are certain rules to this, but generally speaking, you can apply for the Class 2 contributions, which is a lot less. So your missing years will cost you about £180 as opposed to £907 if you had to pay Class 3. So for every year you get back, it equates to about an extra £9 increase in your pension for life, and that's each and every week. So the return on investment is phenomenal once you get to that pensionable age. So it's why, I generally recommend to clients, think about, if you've got the liquidity to do it, seriously think about adding back those missing years. From April 2025, it will only be possible to retrospectively purchase the 6 UK tax years before. Okay, so be very, very mindful that if you leave this much longer, you will miss, the older years that you might be missing will go forever. So think about it if you haven't already done so. And you've got until April, so only 4 months to go. We've been doing regular webinars and warnings on this. So if you're on my YouTube channel, just click on the "Don't Get Your Nicks in a Twist" video, and we can explain, literally step by step what you're seeing here, and the reasons for doing it in more depth. Long story short, once you know what you're missing, then you need to fill in what's called a CF83 form, and you can see it here. And that allows you to to pay your missing national insurance contributions from abroad. So again, just Google CF83 form from the UK government, download it, fill it in, and then get it in the post on its way to the UK. So you're at least in that queue before the deadline. Hopefully that helps give you a little quick overview on how you can top up the UK state pension. One thing to point out on that, once you start to receive it at your pensionable age, it is frozen. You don't get the inflationary increases, unfortunately, being abroad, but it is still a significant amount. And with the rand likely to continue to depreciate over the next how many decades, it's a fairly safe bet that it's going to add a good bit of income stream if you get to the age where you can draw it. Okay, so now that we're parking the state pension, let's move on to private pensions. So pensions that you will have accumulated some value in whilst you've been working in the UK. So this might be a few £1,000s, it might be a few £100,000, and in some cases, it might be over £1 million. So how do we explain these private pensions? Well, let's start off by imagining a journey. Let's say your retirement journey is going to take you from the UK down to Cape Town. I'm completely biased. I make no excuses for it. Cape Town is one of the best places on planet Earth, and you would quite well advised to consider retiring down here. Why? People drive on the left, drive on the correct side of the road. They speak English. The exchange rate is really, really good. You're not far from the UK time zone. So there's a lot of different reasons why you would consider moving to South Africa for retirement. So imagine that journey going to a destination at some point in the future. Now, what vehicle are you going to choose to go from London to Cape Town? Well, you could pick a tank. Why do I say that? Well, because it's very well armored. It's super, super safe. But if you can imagine trundling through the Sahara, it's going to take you a few months at least to trundle from London all the way down to Cape Town. But you're going to be super safe doing it. You might get heat exhaustion perhaps. But yeah, the analogy is a super safe and bulletproof journey. Most people will go in a car, okay, and this is very much what a lot of the UK pension system is like. It's a very homogenous system, and it will get you there in a fairly average time frame, along with everybody else that's in a similar sort of vehicle. Some people want to have a jet plane. They want to get there really quick, but potentially that might be quite expensive, and obviously a plane can fall out of the sky. So what do I mean with this analogy? Well, there's different vehicles or different horses for different courses, depending on your risk profile, what your age is, what you're trying to achieve, etc. But ultimately, you do have some choices that you may not be aware of around the type of vehicle you take on that journey. Let's go a little bit deeper into defined benefit schemes now. So for those that haven't heard these, they are quite rare, but they're defined benefit schemes, often known as a final salary or sometimes gold-plated schemes. They're designed for a bygone era, when people went to a business, worked there for their whole lives and retired from the same company. They're quite expensive to operate. Generally, for the operator or the company, though, they can be quite risky. So for the people that receive them, they're generally slow, low risk and safe. However, for the company, they can put a lot of strain on that business. It's effectively a promise to pay, and they pay a fixed amount that normally rises with inflation, depending on your final contractual arrangements. A lot of the schemes have been in deficit, either currently or previously. And some have been at risk of not meeting their obligations, particularly in the low interest rate world that we saw up until the COVID pandemic. We've had a recent spike in interest rates, which has changed the landscape slightly, but it doesn't mean that we're not going to go back to a lower interest rate environment in the future. So how do these things work? Well, let's have a sort of a case study example. Let's look at Fred as an example. Fred is 60 years of age. He's got a defined benefit scheme, and when he retires, is going to pay him £10,000 a year. What do the pension trustees have? Well, effectively hidden behind the scheme is a number of pensionable assets. And they're normally low risk, low return. They might be bonds, they might be treasury gilts, that kind of thing. So lending money to governments. And if they have, in theory, £1 million worth of assets, they can pay Fred his £10,000 a year ongoing. Fred doesn't really need to worry about what they have, and probably won't ever know what they have invested in. All he's interested in is that promise to pay. Let's just say, though, that the return, and I want to keep this very simple so it doesn't blow everyone's minds, but let's just say the return on those assets go down because interest rates have gone down, as an example. Now, to generate the same return of £10,000 a year, actually what the trustees need to have is now £2 million in assets to generate him the same form of return. And let's say interest rates go down even further, and now £4 million to generate the same income. And this is the conundrum that a lot of defined benefit schemes found themselves in, like I say, in that low interest rate environment prior to 2022, when they really started to shoot up the other way. So let's then have a look at what that means if Fred passes away. So if Fred passes away, he's got his defined benefit pension. Wilma, his wife, is 60 years of age. Normally, only about half would be left to her when he passes away. So now Wilma will effectively get £5,000 a year for her lifetime. This is very, very generic. There are very specific rules on the scheme, so we need to have a look a little bit more in depth to be able to comment. But generally speaking, this is what I find when we look at these kind of solutions. Then let's say that Wilma passes away at some point. What happens to it? Well, people often think that, the children will get the money that's in that pension scheme. Well, unfortunately, most schemes, if they're over the age of 18, sometimes 21, then they're not entitled to it. So effectively, the way we sort of explain it is quite often the pension will die with the second spouse. Okay, so it's an armored vehicle. It's super safe. It's pretty slow. It's pretty predictable. As long as the scheme itself is okay. However, one of the downsides is that if you pass away, you only normally leave a proportion to your spouse, and when they pass away, quite often there's nothing left for the children if they're over a certain age. So let's take more of a real world example then. Say that there's Fred. He's a family man. He's got one of these defined benefit schemes, and obviously in 2020 the coronavirus pandemic came along. One of the things that pension trustees have as an option is effectively to look to pay you an amount to leave that scheme, particularly when, like I say, with that scenario I talked about earlier, they needed £1 million of assets, let's say, to pay you that amount, and then a few years go by, and then actually, it's quadruple. They have to increase their assets to have you on the books, as it were. So depending on what's going on with those, what we call gilt rates, sometimes they will offer you a transfer value to take your funds out of that scheme, and then you're no longer a liability of the scheme. And that figure does change a lot. It's changed a lot, particularly in the last couple of years, but quite often it'll be somewhere between 20 and 40 times the amount that they would be entitled to. So let's say Fred would be entitled to £10,000 when he gets to retirement as a defined benefit scheme. He might be offered somewhere between £200,000 and £400,000 to leave the scheme early and take the cash and reinvest it himself. However, just to be clear, Fred is not a pensionable age yet. So if he transfers it away from that type of scheme, it has to go into a replacement UK pension scheme. He can't just take the funds out, even though he's living abroad. So let's just say that, Fred had taken his £400,000 out at age 40, popped it into a pension pot, fairly generic 5% a year growth. We're not being overly adventurous there. Where do we get to? Well, apparent on that calculation, that 400,000 will have grown to about, just over £1 million. So when he comes to draw on that £1 million, he's going to get £52,500 a year as opposed to the £10,000. The key point, though, and this is where quite often clients want to have a look at this point in particular, though, if Fred passes away and Wilma then wants the rest of the money, currently she would only be entitled to about £5,000 a year in the current setup. But if it's transferred and if it's grown successfully and he passes away and leaves it to Wilma, she gets the whole £1 million pot. And therefore, she can take an income on that of, say, £52,500 a year, around about 5%. Very, very generic, very sort of basic, crude analogies that I'm using here, but hopefully you can kind of see why it makes sense to at least have a look at what you have in place, particularly if you have one of these types of schemes. The other thing as well is that when Wilma passes away, the kids will get the full legacy amount. Obviously, that is currently tax-free, but from 2027, that amount would be taxable. It's still preferential to getting nothing if they stay in the existing scheme. So, it just makes sense to have a look at these kind of older schemes. And one of the things that I hark back to is, generally speaking, as headline sums up, it was from 2017. It's when gilt rates really dropped quite significantly, and therefore transfer values were quite attractive levels. And it said, if a former pension minister's cashing in her final salary plan, perhaps you should do. And that's the message from us, is that if you're not sure, if you're thinking about these things, well, maybe it makes sense to just have a look, and then we can at least know what your options are, depending on what the scheme will offer as a transfer value, depending on where you are in the world and what you want to do. If you want to be more flexible, then maybe something like this might make sense. However, it's quite a complicated process, and only can be considered in conjunction with fully advised professional financial advice. Okay, let's park the defined benefit schemes. Let's move now on to defined contribution schemes. So defined contribution schemes are also called money purchase schemes. It's effectively a tax relief pot of cash, and then quite often it's used to buy units of an investment fund. All of that growth will be tax-free, and it will continue to go up even if you don't add more to it. This is quite a common misconception, that you've worked for somebody, you had a pension, it's with somebody the likes of Aegon, Viva, Standard Life, etc. You don't have to keep adding to it when you come back to South Africa. It will continue to go up in value. Obviously, the idea behind the system when you're in the UK is you contribute an amount from employment as you go, get that pension pot up to a significant amount, and then it'll help fund your retirement. So you've probably got a workplace pension, with the kind of companies you're seeing on the screen here. We deal with these guys all day, every day. And it's not something that's is new to us. We've dealt with virtually every scheme at some point. What do they cost? Well, it depends on the provider. Just reviewed one for a client today with a UK-based advisor, sort of a more boutique UK-based advisor. Typical costs between 1% and 3% per annum, depending on whether it's more bespoke or whether it's more homogenous. And at the end of the day, that's important. But also, what we have to look at is what is the growth projections. And again, quite often, one of the things that I see is clients set these things up. Don't really pay a huge amount of attention to it in the UK, and it languishes maybe in a really like low risk, like a cash-based fund. And actually, they should be going for growth if they're in their 40s and they want to try and improve the value of that in the longer term, if that's what their risk profile is appropriately saying. So generally speaking, the returns in these pension funds can be fairly lackluster and generic. But again, if you're not sure, all I'm saying in this point of the presentation is just check, just go and find out what it is that you have in place. Quite often, though, the downside to these kind of solutions, particularly the bigger companies, is it's very, very generic service levels. You'll deal with a call center. You've got a restricted list of funds. So you're with Aviva or Aegon or Standard Life, you'll have maybe 10 funds to choose from, and there's not really much more support provided than that. So cost effective, but quite generic levels of service. The good things about these defined contribution schemes, I mentioned earlier, if you transfer out of the older style DB schemes, is that the whole pot could be left to your beneficiaries, whether that's the wife or the children, or sorry, spouse or children, depending on who it is that has the scheme. Okay, let's talk about taking money out of pension schemes. So when you get to the age where you're old enough to access them. So a defined benefit scheme, you might be able to access from age 55. However, the restrictions by the scheme might mean it's a lot older, okay? One thing to point out in this, currently, access on a defined contribution scheme is from age 55, but it's going to increase to 57 from 2028. So, unfortunately, you might have to wait another couple of years if you're coming close to that age now. Once you get to the point where you can access your UK pension, you don't have to do it at 58 or 55, sorry, 57 or 55. But normally you would take 25% out of it, or up to 25%, I should say, as what's called a pension commencement lump sum. It's a tax-free payment of cash. And then the remaining 75% will normally be put into either an annuity. You could go into drawdown, where you take a certain amount to live off every single month or every quarter or every year. Or if you want to, there is an option to fully withdraw all of the funds in what's called a full flexi access. We often refer to that in the industry as the Ferrari option. However, very, very cautious or I would highly recommend not to look at that unless you've taken professional advice, because the tax charges can be significant, particularly if you're a UK tax resident. That segues me on nicely to how these sort of solutions are taxed. So generally speaking, as money goes into a UK pension, the idea is it's tax-free going in. And if you stay in the UK and you take benefits out, you're normally taxed at your appropriate income tax rate if you were staying in the UK. If you were to move it to somewhere outside of the UK, and this is what I referred to earlier, the older approach, what's called a qualified and recognised overseas pension scheme, you're going to lose a quarter of your pension fund at that point. So it's one of the key reasons why we just don't do it anymore. It's one of the legacies of Brexit, really. The most common outcome for clients that we deal with is just to leave it in the UK, and instead, when you come to take benefit, make sure that you've got the appropriate treaty relief in place that allows you to access that income at a 0% income tax rate in South Africa. Completely legal. It's an exemption in the Income Tax Act, which I'll cover in a second. And if you do that, whereas in the UK, you might be paying 20, 40% income tax, you're in South Africa, you're retired, and actually your cost base is lower than the UK. And then on top of that, your pension income is tax-free as well. What a pleasure. Why am I so certain on this point? Well, because it's absolutely enshrined, and there's some confirmation from the local revenue authority. So here, SARS, South African Revenue Service, put out this updated, what's called a binding general ruling in March 2017. And what it says here is that Section 10(1) GC-2 exempts from normal tax any pension that's received by or accrued to a resident from a source outside of the Republic as consideration for past employment outside of the Republic. So as long as you've worked abroad for a number of years, accumulated money into appropriate pension fund, then you can draw that when you come to pension access age in South Africa, free of income tax, as long as you didn't add any more to it when you were here in South Africa. There's a calculation to do. If that happens, it gets quite muddy. But simply put, you can claim this exemption, and therefore that income tax won't be chargeable on that amount when you draw down. So if that sounds attractive, or if you're not sure what to do next, one of the things that we recommend is starting off with understanding what you have right now. So we refer to this as a free pension MOT. For those that have been back a while, I'm sure you remember what it's like taking cars for a roadworthiness test every year. And the guys have a look under the bonnet and tell you whether it's still roadworthy or not. We do the exact same thing, free of charge, with pensions. Perhaps you might want to consider an alternative to what you have in place, particularly if you've got lots of pots dotted here, there, and everywhere, and it's a little bit stressful to understand how they all operate and who to contact and what have you. The key thing is having it in the UK, but locally managed here from South Africa. That's what we are here for and what we do on a regular basis. For an ease of an administration process. The way I explain to clients, it's like swapping a red folder for a blue folder. If it's divine benefit, one of the things that you might want to look at is whether it makes sense to do a transfer, because that might make sense for your spouse or children. And might mean that you're more flexible in retirement. However, we have to be really clear that to do that, you need very specific UK-based advice. And so that's something I really wouldn't encourage you to look into without having a conversation with a financial planner with experience on these kind of solutions like we do. What we do is, if we go down that route and you like what we've proposed, what we'll normally do is create a UK-based pension, but we work with specialist providers that are very keen to have overseas clients. And one of the key things, though, is that they can then pay any of the benefits out without the tax deduction, because that treaty relief process has been followed. And again, that's something that we're very experienced on doing. So what does the pension MOT look like? Well, ask yourself the following questions. Do you know who your pension is with? You might think it's with Standard Life, but they might have sold it to Aegon or to Scottish Widows and vice versa. Quite often, a lot of these pension books move around and they consolidate between the big providers. And so quite often it's very easy to lose track of where those funds are. Do you know how much it's worth today? Have you checked it recently? Do you know how it's doing? And do you know what it's invested in? I often talk about the structures of these kind of things. There's a garage, which is normally the pension trust structure. There might be a separate platform. We refer to that as a vehicle. And inside that vehicle might be an engine, which is the investment funds. Is it a 1 litre diesel or a V8 petrol engine? I'll come back to that analogy before about what type of vehicle you're in. And ultimately, that's what everyone gets excited about. What is it invested in? Do you know what your funds are actually invested in? Or is it just in some generic balance fund A or something like that, depending on the provider that you're with? Has it lost much value as a result of what happened in 2019, 2020 and coronavirus and the subsequent market drop? Has it recovered those losses? Is it potentially back to where it was before and above, or is it still languishing potentially? But this point, or this question, is one of the most important ones. How is it performing against its peers? If we looked at your pension fund as a cyclist in a race, is it in the middle of the peloton? Is it way out in the front, or is it lagging at the back, or maybe it's even given up and gone home for an early shower? Those are the kind of things that you have the right to know how it's performing against its peer group. And then once we know all of that, we can project forward and say to you, well, what's it going to be worth in the future? One of the things that we do as part of this process is a free pension reconnection service. So, particularly if you've worked at multiple employers, you might have a few thousand here, a few thousand there, a few thousand there. And we, in the very least, can get you reconnected with all of those pension pots. Whether you choose to do anything with us or not, you're at least back in contact with all of your providers. We do that through a very simple letter of authority. It's only to receive information. It doesn't allow us to make any changes. We would only make changes once you become a client, which is after this initial under the bonnet check, if you decide to go with that. So like I say, very much a free service to get you back in connection with your UK pension pots. One of the things that we'll do is provide a very simple report. We don't go to huge amounts of complicated jargon, so we'll put together a simple UK pension analysis regardless. And what we try and do is give you a red, amber, green scoring on it. So, red is you need to do something urgently, is maybe something you need to be aware of. Amber is it's fine, but green is maybe it's something you might want to consider looking into, or it's fine if it's green, sorry. 4 times out of 10, we normally recommend to leave it where it is. There's nothing to be gained by moving it. 6 times out of 10, though, so in the majority of cases, there is something that we can do to improve what is there historically, and that's ultimately where we come in. Okay, I'm just going to wrap up on the last few bits and pieces. So if you don't have any workplace pensions at all, one of the things that you might want to think about if you're a South African that's come back and didn't pay into that is, do you have something that's similar? So what would you want? And let's look at those reasons why you might want to look at something like this. So do you want to invest in a currency other than rand? So I look at when I arrived in South Africa, it's 15.45 to the rand. Here we are at 23. It's been nearly at 25 rands to the pound recently. 10 years from now, it might be 40 or 50 rands to the pound. Nobody knows for definite. But if I go back to when I first started coming regularly to South Africa, it was 10 to the pound. So generally speaking, will it continue to appreciate? Probably. So, if you've got a lot of exposure in rands, maybe you want to use other currencies like pounds or dollars or euros or something like that. Do you want investments that are away from the policy decisions of South Africa? Again, if you've been impacted by any of those choices historically, then that's one of the things that might motivate you to consider looking outside of the country. Do you want to have investments, everything from gold to property or, overseas shares in Apple or Microsoft or something like that, all in one simple solution? And do you want investments that won't be subject to estate duty if you pass away? All of those kind of things are reasons why you might want to consider, looking at an alternative to what you have in place. Again, we can help with that. So even if you haven't got one of these UK-based solutions, there might be something very similar that might give you some of that protection that you're looking for. Ladies and gentlemen, I hope that that's been worthwhile. I know it's a lot of me going on about very technical things. My general message in summary is that we're here to help. So if you want to have a discussion with myself or one of my team that specializes in these kind of solutions, we're happy to do it, happy to have a conversation and talk you through how we help. Here's all our contact details, so feel free to drop me a WhatsApp or send me an email. You're more than welcome to pop into the office that I'm based at. I'm in Somerset West, but we've also got offices in Constantia and in Val de Vie, and then further afield also in Johannesburg and Durban. I was up in Durban seeing some clients just the other day. So I travel around quite a bit. Long story short, don't hesitate to reach out, and you can follow us on all the social medias here. And if not, if you want to just send a quick WhatsApp, you can do so by scanning this QR code. So if you've got any questions, feel free to ask them now. You can do so by clicking on the Q&A button at the bottom of the screen, or like I say, just sending me a WhatsApp and I'll do my best to answer them now. Okay, see if there's anything that's coming through at the moment. Hopefully that means that I've covered everything in so much depth that nobody needs to ask. Okay. There we go. I'm going to wrap it up there then, ladies and gentlemen. If you want to drop me an email if there's any questions that we haven't covered, please just reach out. Thanks again, everybody. Oh, hang on. One question just popping through here. There we go. All right. So, yeah, from an anonymous attendee, can I contribute to my UK pension once I've moved back to South Africa? Yes and no. Simply put, it's clear as mud. So, yes, technically you can do. As an overseas resident, you can add up to £300 a month, so £3,600 a year into a UK pension pot. Why would you not want to do it, or what might prevent you from doing it? It's probably the better thing to answer. So firstly, sadly, there's a lot of UK-based providers that just simply don't want overseas clients. Without naming any names, there's some high street banks that have debanked clients, cut off and closed their bank accounts. And likewise, I've seen this as well with clients of Santander. I'll name them out loud, on the ISAs front, where they literally just said, here we go, we're shutting your ISA and here's a check. Good luck type thing, which, if you've moved to a different country, is really unhelpful. So that kind of debanking risk is something you've got to be aware of when you move abroad. The other thing specifically, this is just for South Africans that are listening, that exemption that I mentioned before, the Section 10(1) GC-2 exemption, is for when you are contributing into that pension when you're not in South Africa. So if you start putting £300 a month into a UK-based private pension, then potentially what you run the risk of is paying, income tax. That's what the law says here. On the amounts that have been contributed and grown since you've been back here. So it gets quite muddy. So to answer the question, you can, but I would question whether it makes sense. And that's, again, a little bit of a nuanced conversation that you probably need to have with myself and my team. If it's the state pension that we're talking about, absolutely you can do that. And like I say, you can follow my guide. We've covered a little bit of here. If not, just Google on my YouTube channel. You can go and see Don't Get Your Nicks in a Twist. The national insurance contributions is what a NIC is. And if you go to that video, it literally talks you through step by step how you can contribute to your UK state pension once you've moved back to South Africa. Hopefully that answers that question as succinctly as possible. Here's a question that's just come through on WhatsApp from Steve. Thank you, Steve. So what's the kind of growth that we can expect if Holborn are managing my pension fund? Look, hard to answer that question, and I don't want to do the generic sort of "it depends" answer that you get from most people in financial services. But it does depend. It depends very much on your risk profile. But one of the things that we can do is have a conversation where we pin down what your risk profile is, and then we can show you what we've gone and bought for clients over the last few years in that appropriate risk category, and what that has done from a performance perspective. So generally speaking, when I compare side by side, we have consistently outperformed a lot of our peers in the UK that are more generic focused. Why? Well, for example, in the last 2 years, we've really leaned into technology-based assets. So we've bought a lot more tech-focused growth funds from sort of December 2022 onwards. And some of those funds are up double, and some are actually up triple digits as a result. Now, does that mean that they're going to go and do the exact same thing again in future? No. This is where, as an industry, we always say past performance does not guarantee future performance. But ultimately, we will do our best to try and show you what we've done historically and what we feel is coming from a market perception or market prediction perspective. It's very hard to do. One of the things that we would recommend when it comes to pension money is to stay invested in the right kind of assets for you in the longer term. So hopefully that answers the questions best that I can. Unfortunately, what I can't do on this is stray into what might be deemed advice. So I'm just talking about it in general terms. The headline for me is, if you're not sure, have a discussion with us. Let us show you what we can do. We explain all of the costs. It's very, very transparent. We don't do anything that involves any form of hidden commissions, hidden fees. We don't do any lock-in periods, anything like that with these kind of solutions. So it's very, very transparent how we operate. And then the choice is yours if you want to go down that route. Hopefully that answers your question, Stephen. Thank you for it. Okay, if there's no other questions, then I'll wrap it up there. I did say I'd try and keep it under the 40-minute mark. Thanks again, ladies and gentlemen. I hope it's been worthwhile. And please subscribe to our YouTube channel and our Facebook channel. If you've got any questions at all, don't hesitate to reach out. We're here to help, and you can learn from all of the experiences of several hundred other expats from the UK and South Africans that went abroad and came back just like you, and learn what's a good thing to do and what's something that maybe you should think about trying to avoid certain mistakes that others have made. And that's what you get as another benefit of working with my team and I. Ladies and gentlemen, thank you so much for your time. Have a great day, and hopefully speak to you soon.